Insurance works because of a concept called pooling, where a bunch of people pool their money together and share in the cost of something. If, for example, we had 6 policyholders that pay $100 each for their policies, this provides the entire group a total pool of $600 to draw from. Now let's say 2 of these policyholders suffer a loss of $200 each, meaning the group has $400 in total losses. Even though those 2 policyholders only paid $100, there's enough money in the whole pool to cover both of those losses in full. Instead of having to pay for the entire $200 loss on their own, they each only had to pay $100 to have access to the pool of money, which provided them with financial protection for an amount that was greater than what they contributed. As you can see then, using a pooling arrangement is generally cheaper than having to pay for a loss all by yourself. Insurance companies are basically doing the same thing but on a massive scale. By pooling together all the premium money that they've collected from thousands of insureds, they can use that money to pay for covered losses and then keep the difference to cover their own expenses and provide for a profit margin. Pooling allows group members to lower their risk by spreading it out among everyone because it's very unlikely that they will all suffer losses. Pooling does help insurers make more accurate predictions about losses, and it allows them to charge a lower, more affordable premium that still brings in enough money that they'll have the funds needed to cover losses. Insurers do have to be really careful when setting their rates. They have to set them low enough that they're affordable and competitive, but they have to be high enough that it brings in enough funds that they can cover losses. Finding that right balance requires insurers to make accurate predictions about how much in losses their policyholders will have. Pooling helps insurers make more accurate predictions because of a math concept called the law of large numbers. This law states that as the number of similar but independent exposures increases, so does the relative accuracy of your predictions about future outcomes. In other words, the more data you have, then the more likely it is that the conclusions you are drawing from that data will be accurate. That's because you are less likely to be misled by a data point that has an abnormally high or low value. To illustrate why having more data is so important and helpful, let's use an analogy and say you're trying to estimate the average sales price of a home in a particular neighborhood. If you were to only look at the most recently sold home, it's tough to say if that price is a good indicator of the market because what if that home's price is an outlier and it was particularly expensive or particularly cheap? If, on the other hand, you took the average of the sales prices from a bunch of different homes, then that would be a more reliable indicator because that one average figure is far less likely to be skewed by an abnormal price. In general, the more data you have, then the more accurate and reliable your projections or estimates will be. If you're trying to estimate how much you'll have to pay out in losses, looking at the data from a few policyholders is not the best approach because your numbers could be skewed if any of those customers had a loss experience that was out of the ordinary. Again, the more policies you can include in your data pool, then the more likely it is that your final calculation will be a good representation of what you can expect other customers to experience. Now, selling insurance is not the only way that an insurance company can provide value for their customers. Another thing they can do is risk consulting, which involves giving insureds advice on how to more effectively manage their risks. More specifically, insurers can provide customized advice on risk management strategies by advising on what insurance coverages the insured should have, how the insured can save money on the risk management strategies, how the insured can improve safety and reduce losses, and how the insured can improve their competitive advantage. More and more, insureds want their insurers and producers, meaning the agents and brokers that are selling them the insurance, to give advice on how to reduce losses. This is especially true of commercial insureds who want to avoid the business interruptions that come after losses occur. In order for your risk consulting to add value, you must first do a quality risk assessment so you can thoroughly understand what risks need to be addressed. The first step is to gain a holistic picture of your customer by learning about their goals, strategies, risks, strengths, weaknesses, opportunities, and threats. You must then analyze specific things that relate to how their business operates. This includes finding out what property they own that needs to be protected or insured, what products or services they offer, which will present different risks and exposures, if they have employees, and the nature of their interactions with their customers. In order to gather this information, there are many different tools you can use. Examples include checklists, surveys, questionnaires, loss histories, property inspections, and industry-specific underwriting or loss control reports. Besides looking at the customer's specific individual characteristics, you should also consider any external environmental conditions that may affect the customer. This can include things like the customer's competition, the regulatory environment, and any potential supply chain issues. Nowadays, insurance professionals have to adopt a predict and prevent mindset, where you use technologies to anticipate losses and then stop them before they occur. This has been driven largely by customer demands for insurers to reduce premiums and to help the customer lessen the physical and emotional setbacks that arise after losses happen, because losses are still super disruptive even if the insurer ends up covering the claim. Some of the key technologies that can be used for risk management include smart products, sensors, wireless sensor networks, big data, telematics, wearables, the Internet of Things, smartphones, cloud storage, predictive models, artificial intelligence or AI, and data science.